Hello everybody, and welcome to this video entitled 2 More Stocks to Benefit from the 2024 Rate Cuts. The video that I made 2 days ago got a lot of feedback in the comments section, and so first of all I just want to say that yes, all assets in general will rise when interest rates go down, but these videos are specifically for stocks whose products are very dependent on interest rates. And many of you pointed out in the comments section that I may have missed out on a few stocks. So I want to point out 2 more stocks that I believe will benefit from these cuts, these rate cuts that are now announced, predicted by the CME Fed Watch tool. If you look at where pundits are as far as the rate cuts, they're predicting those cuts as early as March of 2024. And then we see a slew of rate cuts that are predicted throughout 2024, which means that the products of the companies that I've described in the prior video, where I had Tesla, I had Enphase, I had Hinmode, those products should see a rise in their sales. But there's 2 more stocks that I want to point out that may benefit from this. One of them is one of the stocks that I've covered on the channel previously for the E Must Do Something portfolio, which is Lovesac. Lovesac is a new brand. It's a furniture brand. It's a new furniture brand for millennials, for Gen Z. I've highlighted it as in prior videos on the channel. I've done a full analysis on Lovesac. I've compared it to La-Z-Boy and talking about how La-Z-Boy was kind of the lazy economy of the 20th century, and the lazy furniture, the lazy economy, the lazy brand, quote unquote, of the 21st century, I believe could be this one, Lovesac. And of course, I got drawn to Lovesac because of its insanely cheap valuation at an enterprise value over gross profit over revenue growth of 0.089. This is the third cheapest in my spreadsheet of all of the stocks that I analyzed. This is the third cheapest on a growth adjusted basis, but that's only because I'm only predicting 15% revenue growth for next year. What if they were at 30%? Well, you'll get into a 4. So very, very, very cheap here. And even if you look at a price to sales basis, this is a company whose trailing 12-month revenue is $689 million. It's trading at 519 billion. So this is a dirt cheap company. And if you look at these products that they sell right here, keeping in mind that a typical couch arrangement, and most of their revenue comes from selling these couches, a typical arrangement is going to be $7,000 to $10,000 for a decent couch arrangement with them, and their bean bags are right in line with the cost of, say, a La-Z-Boy recliner. So I always say this is a competitor to a recliner. $1,500 if you want to have a fancy cover with it. But you see how they sell. How do they sell these products? Well, with the credit card, with the store credit card, as it's usually done in the furniture business. Get 24-month professional financing. What's going to happen to that financing as the rate cuts come in 2024? Well, the cost of personal loan is going down, and that means that the demand for this type of product is going back up. And this, in conjunction with the fact that real estate is going to go back up as well because mortgage rates are dropping, gives me confidence in this stock's revenue growth, and the idea that the stock's revenue growth here is only up from here. No investment, no financial advice, of course. And when I look at the stock chart, you see this stock has been quite a roller coaster, but it's actually quite back up to the depressed level of even October. But as far as 1 year back, looking 1 year back, it's gone nowhere. It's done nothing for a year, and I believe that this is a stock that could get back to growth. And I'll be looking at this stock over the next few months, and perhaps accumulate a position on this company. The other company, one that I have not covered a lot on the channel lately, mostly because it's one of my more controversial holding, but it's Opendoor Technologies. And if I look at the way Opendoor stock is trading, if you look at the past 4-5 months of Opendoor, it's almost the inverse correlation of the 10-year treasury. Let me do it like this. If you do it like this, I mean, isn't that uncanny? Look at this curve right here of the stock, and look at the inverse of a 10-year treasury. This is almost trading at the inverse of a 10-year treasury which tells me that there's still not much price discovery happening on a stock like Opendoor. A lot of people are still missing the big picture on this stock. I have myself my doubts currently about Opendoor, mostly because right now they are operating as a home flipper. I am a former 2-time Opendoor customer. And I'm under contract with a traditional realtor for a house that I'm trying to sell for the second time, because my home that Opendoor tried to buy from me, they gave me a lowball offer, something almost 40% lower than market. And I got a full price offer the first time. And it's a traditional, typical realtor business, and the buyers, that was a month ago, they didn't get their financing, and so they had to pull out of the sale, and so it got back into the listing, sold it again near full price, just dropped the prices of a couple $1,000. But yet again, this is going to be the same story. They have to go through their financing, their loan, and they have to get their loan. Opendoor removes that uncertainty when you sell a house, the uncertainty, the risk as a seller of your buyer not getting their loan, which is the main risk you bear as a seller of a house, is your buyer not getting their loan. They bridge that by being the liquidity provider. They're the liquidity provider. They have their multi-billion-dollar line of credit with various banks, and they just hold the houses until they are purchased, and they charge you a fee for that price, and that's typically a 5% fee. So what happens is the initial idea of Opendoor is not to be a home flipper, and I don't like that they're operating as a home flipper right now, because they have Carrie Wheeler. She's a CFO. She's the former CFO, now CEO, and they're doing the lowball. And now I'll be wary about submitting any other offer to Opendoor because of the lowball nature of the offers that they've been making. But if they go back to their original idea, I think this could be a major disruptor of the MLS in the United States and the real estate market and the way we buy and sell homes. It's true that we buy and sell just about everything now with a buy now button, right? How do you buy a car in the modern times? In modern times, you buy a car, you go on Tesla.com and you pay $1,000, and then you pay the remainder of a fee at delivery, and it's all done digitally. And we still operate real estate sales like it's the early 20th century, which it's not. It's not. And in fact, the job of a real estate agent has entirely changed. And that 6% fee, I would argue today, is much too high, because most buyers of real estate, most of these buyers, they just go on Zillow, and they just go on different websites, and they do their own search online. They go online to do their search. Essentially, a third of the job of a real estate agent has been gone because of technology, and is now just done by the buyer because all of their information's out there for reading. And so that's the idea of Opendoor. Instead of selling through a real estate agent and paying a 6% fee as a seller, sellers will just opt to sell their homes to Opendoor and pay a 5% fee instead of a 6% fee, because they are essentially doing more themselves today. And of course, the 5% fee now, when I started covering Opendoor in the early days of the channel a year and a half ago, the fee was as low as 4% for what I call the round trip, which is when you coordinate a sell to Opendoor and a buy with Opendoor on the single platform. You could, and they don't do it now anymore, but you could reduce that fee to 4% instead of 6% by just going through Opendoor. Opendoor was a disruptor of the real estate market, so a much bigger total addressable market in the early vision of the company compared to the current vision, which is they are still operating as a home flipper. But this is a stock, and if I see them move back to the original vision of the company, I will add again to my position. I still have my position. It's been a roller coaster. It hasn't moved. It hasn't changed. I'm actually just about break even in the position. But who knows? I mean, if drops keep dropping, and if we get in the low 3% or high 2%, will this inverse correlation? I mean, look at how uncanny this is again. If we move back to this inverse correlation, are we going to see the stock go back in the 7, 8 buck range, I believe it's entirely possible. Why? Because, of course, the real estate market is strongly influenced, at least in the short run. In the long run, I believe it's influenced by the fact that people need a home and people need a place to live. Right, that's the Austrian economist in me, and they'll buy a place even if it's a 5% or 6-8% mortgage. They'll still buy a place because they need a place to live. That's long run thinking. Over the short run, people are thinking, well, I'm just going to hold off a year or two to buy a house. I'm just going to hold off a little bit because I want interest rates to go down. And there's a lot of pent up demand, and I think that pent up demand is returning to the real estate market, and that's propping a stock like Opendoor, who makes money on transactions, on the real estate transactions. So Opendoor, in my view, is the other stock that will greatly benefit from the 2024 rate cuts. And I look forward to seeing what this stock does. Anyways, this was not investment advice, no financial advice today. This was just entertainment. Please like, please subscribe. Thanks for watching, and have a wonderful day.